From 11FS, this is Fintech Insider News, and I'm your host, Ross Gallagher. Thank you for downloading this podcast, especially you buying that sandwich. This week, we're talking Shopify launches credit card, expanding its ever-growing suite of financial services products. HSBC partners with Tradeshift. Hear what our panel thinks about the potentials for embedded in the B2B space. And is it ever okay to lie on your resume? Probably not about balloons. We get into all this and much more in today's show, but first, a few brief messages, so please stick with us.
A lot of you know 11FS for our chart-topping podcasts, our events, videos, reports, and a bunch of other cool stuff that we do. But what a lot of you don't know is that this is just all our side hustle. We do so much more than that. At 11FS Ventures, we're partnering with ambitious businesses around the world to design, build, and launch truly digital financial services. We are building banks, shaping new propositions, and growing existing offerings that change the fabric of financial services. And our design, research, strategy and engineering experts are working to improve your customers' relationship with money. To find out a little bit more, check us out at 11fs.com/ventures.
Hello and welcome,
LFG people,
to Fintech Insider,
Blockchain Insider,
11FS Spotlight,
11FS Explores,
Open Mic Night,
After Dark.
Through our podcasts, videos, newsletters, and live events, we have a direct line to a truly global fintech community. So if you're looking to sponsor and collaborate on content that connects with everybody from fintech beginners to the biggest VCs, then chat to our team at sponsors@11fs.com or visit 11fs.com to find out more.
Long live the community.
Hello and welcome to episode 768 of Fintech Insider. I'm Ross Gallagher, Ventures Director at 11FS, and I'm joined this week on Fintech Insider News by some great guests to break down this week's biggest stories in fintech and financial services. Firstly, I'm joined by my 11FS colleague, David Barton-Grimley, Director of Fintech Strategy. David, as ever, great to have you. What's been keeping you busy lately?
Well, Ross, I've been looking into Google Meet's new background filter features. I know it's not a fintech subject, but this week I've been an astronaut, I've been a chicken, and various other things. I mean, I wouldn't recommend it for kind of business or client-related meetings. I don't know, it just gets a bit weird there. But for internal meetings, I'm a chicken.
I like it. I mean, it helps to break the ice at the start of meetings. So no, nice that you've given that a good once-over. We also have a very welcome return to Fintech Insider for Valentina Kristensen, Director of Growth and Communications at OakNorth Bank. Val, thanks for joining us. Not that people will necessarily need reminding, a good friend of the show, but maybe you can just tell us a little bit about yourself and a little bit about OakNorth Bank.
Sure. Thanks so much for having me back. So I've been with OakNorth for about 8 years now. I returned last week after 6 months of mat leave. So, very excited to be back. And OakNorth, for those who may not be familiar, is a fintech focused on empowering the missing middle, basically mid-sized companies that we feel have been overlooked and underserved by traditional financial services.
Well, Val, great to have you. Huge congratulations. And thanks for jumping in like a week after you've come back as well. We're thrilled to have you. And last but by no means least, we have a Fintech Insider debut for Shehan Silva, Head of Digital Solutions, Global Trade and Receivables Finance for HSBC. Shehan, welcome to the show. We'll get to your exciting news in just a little while, but maybe you can just give the listeners a bit of an intro to yourself and your role at HSBC.
Thank you, Ross. And it's a pleasure to join you for the first time. I've been listening to your podcast for some time now and really excited to be here. So as you said, I'm responsible for digital solutions for trade finance. And what that means is it includes all the digital proprietary channels like web, mobile, etc. that clients use. But more recently has included some of the embedded finance solutions and partnerships that we have. So that includes situations where clients are trading on marketplaces, e-commerce portals, maybe using accounting systems, and embedding our financing solutions on those platforms for clients to access finance. So very excited to be here and talk through these through these topics.
Yeah, super interesting, Shehan, and we're excited to have you. And thanks for coming on to share all of your insights and experience. So with that, then, let's get straight into the news. So the first story this week comes from TechCrunch with a headline, Shopify expands into credit cards as it pushes further into the fintech space. So Shopify has entered the credit card game. The commerce giant announced that it is offering Shopify Credit, a business credit card designed exclusively for its US merchants. It's powered by Stripe, issued by Celtic Bank, and accepted everywhere Visa is. The credit card is designed to evolve alongside the merchant's business, adjusting the credit limit to accommodate business growth from $1,000 to $100,000 per month at its launch. Now, to find out more about how Shopify sees their credit card offering supporting SMEs right now, we reached out to Vikram Anreddy, Shopify's head of product for financial services, for more information.
We heard from our merchants and entrepreneurs again and again on how complicated business credit cards can be. The application process is difficult, credit limits are small, rewards are confusing and hard to redeem, and there are lots of hidden fees. Couple that with the macroeconomic environment where access to funding and credit is really difficult for small businesses. That is why we are launching Shopify Credit, a pay-in-full business credit card that has been exclusively designed for Shopify merchants and entrepreneurs. It offers 4 benefits. Number 1, we set credit limits based on a merchant's business performance and not based on their personal credit history. The beautiful thing about this is that credit limits will grow as the merchant's business grows. Number 2, we offer up to 3% cash back on categories where merchants spend the most on, things like marketing, fulfillment, and B2B wholesale. Number 3, a lot of our merchants can go from application to approval to having a virtual credit card in their wallets all within a few minutes, not days, not weeks. And number 4, this is a very transparent credit card. We have no fees of any kind.
So Val, it seems only right to come to you on this one, given OakNorth's sort of focus on that SME financing space. I guess some of the pain points that you heard there are probably quite familiar.
Yeah, I mean, I think, look, there's a huge difference, obviously, between a business credit card and the type of loan that OakNorth offers, right? Which is typically long-term, repayments over 3 to 5 years, revolving credit facilities, and we're talking about millions of pounds as opposed to, a credit card limit of a few $100,000 perhaps at the very highest level. I think, though, what's so interesting about this approach, and I think it's definitely the right approach, which is that you see so many fintech players, that try to be all things to all people, right? They come to market with a proposition where they're offering literally anything under the sun in an attempt to get that low-hanging fruit and just get as many customers as possible. And that will obviously help them with, future funding rounds and higher valuations. But what Shopify has done, which is so interesting, is sort of saying, well, we know the unique pain points of our customers because we've been working with them for this many years. And so we've designed a proposition that's specifically for them. We're not trying to go out and compete with the rest of the credit card market, and target people and businesses that don't currently, work with Shopify. What we're saying is we know that for those Shopify customers, there's a lot of pain points. And if we can help them address some of those pain points, then they're ultimately going to be that much better as a business. They'll be able to function that much better as a business, and then Shopify will sort of have an indirect gain as a result of that. So it's a very, very smart strategy, and it really is a place where they feel they can play to win. That they're not trying to gain sort of huge market share necessarily, but they do want to gain the market share amongst their customers. So I think it's a very smart strategy. Obviously, if you look at credit cards, I mean, a number of those pain points were addressed there. Of course, there's pain points when you're applying for a loan as well, right? The application process is going to be much longer than filling out a form online. You might have to, have a conversation with credit committee. The documentation you'll have to produce will be much more, there'll be much more of it, and it'll be much more in depth. It's not based on sort of a credit score based methodology. So they're going to be asking, a lot more information in terms of the due diligence process and the credit process they'll have to go through. So as they should, because you're talking about loans of, potentially millions of pounds. So I think you can't really compare them. It's really about finding the right solution for your business. And if your credit card is the right solution because you need money quickly and just a smaller amount of cash, a loan might be a better option if, you need a larger chunk of change. You want to be able to draw down from it, large sums from it over a certain period of time. And perhaps, you're in a business that's of a certain sophistication and size that now you think you can qualify for a loan, whereas before you may have only felt a credit card was your best credit option.
Yeah, it's super interesting. I mean, I remember speaking to Rishi quite a few years ago, and him saying that the average, I think, time even just to get a no from a high street bank was like 6 months. This is kind of happening in minutes. Do you think, because obviously, look, this is a big improvement on that. How do you feel about, we're starting to see more things come to market now to better service the financing needs of smaller businesses? Do you think we're moving in the right direction? Are we starting to see some material progress?
Look, I think definitely in terms of small and micro businesses for sure. And you've seen that not just in credit cards, but you see it in the day-to-day transactional banking offerings of Tide and Revolut and Starling Bank and Monzo Bank. There's a really broad array of products and services that are now kind of targeting the small and micro, and in some ways those fintechs and those businesses that have had individual consumers like you and me as customers. It's not so difficult to add a little bit to it to then make it, suitable for a small business or a micro business where you may only have, one individual, one director, one ultimate business owner. Obviously, though, once you get to that mid-sized company, which is really more where OakNorth plays, and you're talking about revenues of 2 million up to 100 million every year, then, needs become much more complex. Legal structures become much more complex. And that's where I think, there's still a huge amount of work that needs to be done. That just requires that additional level of analysis, that additional level of due diligence, which obviously takes time, technology, investment, and those are things that I don't think we see enough of in the market. The sort of targeting those mid-sized companies, but certainly, yes, I think it's great to see more offerings for small and micro, and hopefully in time we'll see that investment going into the mid-size as well.
Completely agree. Shehan, what sort of stood out for you when you read about this story, this product?
I think it's very exciting because if you look at a lot of the marketplaces, there is a need for these merchants to have access to some form of credit, right? So the fact that Shopify and other marketplaces are coming up with solutions attracts these merchants to that marketplace because it helps them to sell more. They have an ability to, source products and services that help these merchants produce, stock goods, and ultimately that indirectly, as well mentioned, allows the Shopify to get more business as well. So I think that's very exciting. I think from an SME perspective, the trend to offer more financing products to that segment is also positive, particularly from the likes of Shopify, where they have a potentially large user base or customer base. So it could really make a tangible dent in the adoption and how many merchants have access to the products. And it's complementary because, different entities, whether it's HSBC or other entities, may do loans, and there is a place for cards and for loans, depending on the size of the customer, depending on the strategic nature of the goods being purchased, depending on the size of the transaction. So all of this fits in quite nicely to make sure that we are meeting customers' needs.
Yeah, I completely agree. And I think there's something in it as well around, the fact that this isn't necessarily based solely on credit checks, that this is based on the performance of the business. Val?
Yeah, I mean, I think, that's it. It's based on that unique information that Shopify has on the customer. And that's so important because, as I say, you often get the experience as a small business where you go to an institution and you're sort of given a menu of items to choose from. And that's really whether you go to a neobank or, one of the big five. And it can be a bit overwhelming. And you may not have the sophistication internally, the structure with a CFO or a finance director to know what products are the right fit for your business. So the fact that Shopify can then say, we've seen your spending, we've seen how your business operates, and this would be our recommendation to you. You're kind of doing a lot of the hand-holding with them, which I think, those small and micro businesses that are starting out will really appreciate. If you're a bigger business, a mid-sized company, you probably have an FD, a finance director, or a CFO, and you've probably, had the same credit card for many, many years, and you've probably got a credit limit that's working well for you. Potentially, you've taken out loans before, so it's just a bit different, and you may not benefit as much from that kind of hand-holding. But I think, certainly for those smaller micro businesses. So again, I think it's just a really smart move from Shopify of knowing their customer and saying, we think we have a right to win here. So, let's go for it.
Yeah, no, I completely agree. And it does feel that little bit more, friendly is the wrong word, but it does feel that more like a partnership. They're kind of working with you, helping to sort of grow your business. David, what were your thoughts on this? And I think Shehan mentioned in particular that sort of the notion of putting that finance at the point of need, right? I know that's something that you're particularly passionate about.
Yeah, I mean, I think as both Shehan and Val were saying, it's all about really understanding the data. And this is the wonderful thing about these digital marketplaces. They have the data, and therefore they can then do something with that data in a meaningful way that then builds up the overall value of the marketplace. But from a Shopify perspective, you've seen them getting more and more confident. And for me, this is just the latest example of the kind of products that they've been launching in the embedded finance space. So they started with Shopify Capital all the way back in 2016, which is a bit of a no-brainer for a digital marketplace in some ways, right? It's merchant cash advance. So we know what your forward order book looks like, so we can just lend against that. And they've moved from there into lending, into more financial services features, and now into a credit card. And you can see what they're doing here, right? They're becoming more and more like a full-service financial services institution for businesses that trade online, which is very interesting for their business model because they're taking it way beyond the, very small shops that use us, and in fact, actually maybe up into the slightly larger businesses because you're getting larger and larger businesses with more of those complex needs that Val was referring to, using platforms like Shopify to run their businesses. So I think it's a very interesting area to move into unsecured credit, unsecured lending for a small business, albeit at a very small bite size. And it'll be interesting to see where that takes them.
I totally agree. One thought, David, and we're over on time, so we need to be quick. But just as you were saying that, and it's great to have a one-stop shop, but I guess I'm thinking about the news that we saw this week with like Etsy holding back funds and really pushing sort of small retailers into quite difficult financial positions. Is there a risk for businesses in everything that you've just described that Shopify becomes a little bit of a single point of failure?
Yeah, absolutely. I mean, a lot of the problem for the businesses and even the consumers is you don't really understand what the bank is that sits behind this, right? And this is where some of the regulatory pressures come in around how viable banking as a service actually is. So you look at it from a customer, and I actually have a real case of this. So I have eBay holding money of mine in a wallet that they won't release until the person who's bought my sofa is able to scan a QR code. So this is exactly the same kind of issue. And I don't know when that's going to happen. I haven't had any contact from her, so I don't know whether or not she's received the sofa. It's exactly the same kind of problem at scale. There's definitely a transparency issue, which over time needs to get resolved. I mean, we also just don't know how liquid these firms are, right? Like, how liquid is Etsy? I'm trusting my money and my business with this huge startup-funded business. Like, how viable is it?
Yeah. All right. Our next story comes from AltFi with a headline, HSBC launches embedded finance venture with Fintech Tradeshift. So B2B fintech Tradeshift has secured $35 million in funding from HSBC as the two jointly launch a new venture creating an embedded finance solution and financial services app. HSBC and the Danish fintech will create a range of digital solutions across both Tradeshift and other platforms. This will include payment and fintech services embedded into trade, e-commerce and marketplace experiences. So Shehan, obviously great to have you here to discuss this. Maybe you can just give us a little bit of the background on how this joint venture came together.
Oh, sure, Ross. So we've been working with Tradeshift for a few years now. And if you look at banks and these fintechs in the past, for a few years, we've been integrating with these fintechs and providing solutions to the larger customers. Now, Tradeshift is also a network. It's got the larger customers, but it's also got a massive number of SMEs and smaller customers. And the opportunity is that, similar to what we've been discussing before, it's about how can you embed finance to make that finance available to a larger number of smaller suppliers. And that's how the joint venture idea came about, to be able to offer financing to these suppliers. To do this, there are three broad areas that we need to focus on. One is, of course, the users, the traffic, the suppliers, and that's where it allows Tradeshift to focus on building that network, building that traffic, providing solutions to users to increase the throughput through their platform. It allows HSBC to develop financial propositions, and the JV comes in the middle to have the technology to bridge the two and to provide these financial services apps that can be embedded within Tradeshift to offer the products or propositions that HSBC develops. So I think that's how it came about. So the JV will really be the best of both worlds: the technology from Tradeshift side, the balance sheet and expertise on financing products from HSBC, and the ability to take that to many geographies around the world.
Yeah, it's an amazing insight really into both how it came together, but then I suppose the benefits both for HSBC and Tradeshift and of course end users. I know in the story we said that you're looking at creating a range of sort of digital solutions across Tradeshift but also other platforms. Are you able to tell us a little bit about what sort of digital solutions are on the cards?
Sure. So Tradeshift's core products are AP automation, in effect, things like e-invoicing, purchase orders, this kind of thing, and marketplace solutions, where they provide marketplace solutions to marketplace operators, for instance. What that means is that users on Tradeshift or customers on Tradeshift, whether that's the big buyers or the large number of small suppliers, there's a lot of invoices, purchase orders, trade traffic that is moving between these customers. Now, these invoices, purchase orders, details of transactions can lead to different opportunities in terms of the financing propositions that can be offered. One is there's an invoice, it's got to be paid. So there could be payment products associated with that, things like wallets or simple payments. Secondly, there could be financing products. So there is an invoice, it's got to be paid on a particular date, or it is paid at a future point, and that money needs to be advanced now. And then it becomes whether it's receivables or a payables financing, where cash flow needs are delivered that way. Thirdly, there's also an opportunity for card products. So similar to how we just spoke about Shopify, there is a transaction. It has been a trade transaction where someone has purchased something from someone else. There is an opportunity to use a card. And of course, then finally, there is also some element of foreign exchange that could be involved. So it's kind of a broad cross-section of products, I would say, across payments, across foreign exchange, across financing, that really brings everything together to make sure that transaction of buying and selling can be fulfilled from the financing solutions that are needed.
Yeah, And really interesting what you're saying. I mean, lots of different use cases, but I think also lots of different pain points within each of those use cases that you could really help to solve for. Shehan, you mentioned in your previous answer about different geographies. I guess what markets do you see as being sort of key to this?
So both Tradeshift and HSBC have a very wide footprint. We have a commercial banking basis in over 50 countries, and that really allows us to take this far wider than one or two countries. So I would say, Ross, instead of saying which countries we are starting with, there are a few parameters that will help us decide where to go, and those are based on where the clients and the need is. So whilst embedded finance and accessing finance via platforms is common in several markets, some markets are more advanced than others. So client need, client traffic, that's the first angle there. The second is where the regulation, governance, digital solutions, digital embedded finance is positive, and we see more markets that are open to this. We see more markets that have passed regulations around digital invoicing, for instance. So that clearly is some countries mandate that invoicing should be done digitally only. So then clearly those markets become a priority because there will be more digital invoicing traffic to finance. And then finally, where both from a Tradeshift perspective and from an HSBC perspective, where capability and investment exist for us to be able to develop products. So there's a range of markets that meet these parameters. I would say across Asia, Europe, and the Americas, where we would be looking to deploy this capability.
Yeah, it makes a lot of sense. Shehan, look, it's great to have you on to sort of give us that peek behind the curtain into the sort of background and how this all came together. So thank you so much for that. David, we mentioned some of those pain points, I suppose, particularly in that sort of B2B world. It feels like there's a real role potentially for embedded to start to solve for some of those.
Yeah, and I feel like the entire fintech industry has been excited about and talking about the potential for embedded finance in the trade finance and supply chain area for a very long time now. And I think it's wonderful to see this example, and I hope maybe it is a bit of a shining light for other banks and for other use cases to get into this. I wonder whether there's a very interesting moment in time that's happening right now, right? Like, businesses that exist in very, very complicated supply chains always need capital. I mean, that's been the case from day one. But what we have at the moment with COVID, with the war in Ukraine, with the supply side crunches that we've been having, a real issue actually for businesses that exist inside very, very complex supply chains. And Tradeshift have an index themselves that they released, actually, their Q1 2023 index, showing that economic slowdown has left firms sitting on record inventory, which means that the need for cash is way more pressing, I think, than it's ever been. So the business case for a very large bank like HSBC in some cases becomes a little bit more academic. It becomes much clearer. We can make an investment and we can actually make a return on that investment in a way that perhaps we couldn't before because the need is more pressing. And an organization like Tradeshift actually has the data. They're sitting on the data. So as Shehan was saying, they can do something with it globally in a very, very meaningful way. So I just think it is a shining light. And, we've seen other trade financing platforms online launch their own lines of capital as well. Hopefully this year and next year we'll see more and more growth in this area.
Yeah, I completely agree. We often hear about, sort of, I suppose, non-traditional players, whether they sit in the supply chain or whether they're providing POS terminals and all of that sort of stuff, actually sort of disintermediating the traditional banks in this space. That's often the context that we hear about this in. But actually, this is a great example for the sort of benefits of both coming together, right? Val, what was your reaction to this story? Keen to get your thoughts.
Yeah, I mean, I guess, I think, it makes me think about some of the, the partnerships that we've had at OakNorth and some of the investments that, that we've made investments in. some of the businesses that we've made investments in are some of the businesses that we've lent to. We obviously have lots of kind of partnerships at the back end, right? With ClearBank and Comply Advantage, TrueLayer, and at the front end, we've partnered with, the likes of Monzo and Raisin. And it's sort of trying to find those partnerships that make commercial sense in terms of what you're trying to achieve as a business, but also where you feel that, from a customer service and a customer experience standpoint, it's not embedded finance, but how can you make the experience feel seamless and like they're not having to bounce from you to then back to another institution, then back to you, and that if they do have a challenge or a question or a problem, that they know who to go to for it, and they're not sort of calling you up and saying, "Can you help?" And then you're like, "Sorry, you have to go to Monzo for that." And then they speak to someone at Monzo and they say, "Oh, you actually have to speak to OakNorth." That's not an experience we want. So I think trying to niggle out some of those things early on can then help to ensure a good long term partnership.
Yeah, completely agree. And look, to your point as well, I mean, a better experience and better outcomes for end users, right? Okay, well, look, I am going to take us just for a quick break. So we'll be back with you very shortly.
Fintech Insider community, we need your help. The 11FS Awards returns on Wednesday, 15th of November, and we will be celebrating the people and businesses from across the globe who are helping to move the industry forward. This is where you come in. Do not miss your chance to influence who takes home an 11FS Awards trophy, whether they're trying to make the world a better place for their customers, changing the game for businesses, or utilizing AI to improve their customer experience. We want you to tell us who is building the best stuff. Submit your nominations right now at 11fsawards.com. That's 11fsawards.com.
All right, welcome back. Now let's get back into the news. The next story comes from Fintech Finance with a headline, Global Fintech Funding drops 17% to $52.4 billion in the first half of 2023. So global fintech funding fell to $52.4 billion in the first half of this year, according to KPMG's latest report. That's down 17% from $63.2 billion in the second half of 2022. Investment activity in the US makes up a big chunk of the total global funding, with its $34.9 billion accounting for more than 2/3 of the $52.4 billion seen globally. So David, maybe I'll come to you first on this. What do you make about the story and some of the numbers?
I mean, it's stinging, isn't it? I mean, I wonder whether a part of the story is just due to the natural landing that the wider economy is making all over the world from the glut of investments and growth that happened during COVID. And you're seeing this absolutely everywhere. One thing, though, that I find kind of interesting about it, more on the optimistic side, is that it's not all bad news. So the things that are getting invested, I mean, we've been talking about supply chain today, for example. So within the report, it is things like supply chain and logistics which are seeing the most record growth, and also things like green fintech doing really well, more than it's ever done. So I wonder whether what we're looking at here is more of a rebalancing and a reshifting of where the investments have been made before, into more, shall we say, classic or standard fintech business models that, as the investments have been made, it's become increasingly difficult to see where the exits are going to come from, right? Some of these markets are extremely competitive. Some of these markets are also very, very small. So if you look at countries in Southeast Asia, for example, or some countries in Europe that have seen a glut of investments into things like neobanks and BNPL lenders and whatnot, you hit a point, I think, very, very quickly once you spent your cash acquiring all these customers, and actually in some cases spending a hell of a lot of cash acquiring customers, hundreds of dollars you hear sometimes. You hit a wall. Who's going to buy you? Where is your profitability? So, as bad as it is in some ways, I think what we're staring at is a more positive future that is more profit-driven, and that might be more focused on solving genuine unmet needs.
That's a really interesting point that you make. I mean, as the market cools and as funding levels off, investors are clearly being a lot more intentional and maybe purposeful, right, in terms of what they're investing in. Val, keen to bring you in. What are your thoughts?
Yeah, I mean, I think, first of all, I'm surprised it's only 17%, to be honest. Last year it fell by 33% compared to the year before. So, it's arguably twice as good this year as it was compared to the previous year. The other thing is, obviously, it's all context, right? I mean, if you look at some of the other areas of tech, biotech funding's fallen by 40%, food tech's fallen by 36%. I get the overall investment numbers in those sectors are obviously much lower comparatively than what you might have in fintech, but even tech overall is still down 37%. So 17%, isn't too bad. And I think, kind of David's point, it's about the industry sort of growing up. And as we know, part of growing up, you have to go through puberty. This is the sort of slightly uncomfortable period. There's a lot of unwanted change, change that often comes along very quickly. You're not quite sure how to deal with it. And maybe you don't necessarily want to talk about it. But it's change that kind of has to happen in order to kind of take that necessary step to adulthood. And what we'll hopefully have is at the end of this, as David kind of put out, more sort of mature fintechs that have managed to build really resilient business models. And I think the number of fintechs that weren't profitable for a really long time and have in the last 18 months switched to profitability, even if it's just on a month by month or quarterly, on an initial quarterly basis, is a really positive thing. And you've seen that in the wider tech sector, right? Uber obviously has just become profitable for the first time, after many, many years and several years being a listed company. So I think, it sort of drives some of that maturity, which is really important for the future of the industry.
Yeah, it's interesting actually, because I think the headline, the story reads as quite a negative one, but actually there's a good amount, I think, of optimism, Val, coming both from yourself and DBG. And actually the puberty analogy is helpful, right? Like it's an uncomfortable time. And like you said, sort of, I suppose, young and fun businesses they're going through this uncomfortable process of having to become more, as you said, mature, resilient, and I suppose sustainable. And we've seen the high profile sort of like down rounds and layoffs across the sector and all of that sort of stuff, right? So it is uncomfortable. Shehan, what was your sort of reaction to this story, and how do you think this plays out over time as we move forward?
Yeah, I think a few thoughts. I think the expectations have changed in terms of the interest rate environment and the macro environment, right? So I think there are, apart from the profitability situation or the background around fintech in general, the environment has changed, and it might be for a period of time. It is not going to be for a decade, right? So what that means is that the sources of funding have other channels to get that return. And also, from a larger bank's perspective, when we look at investments, we look at returns. So, you're discounting the future cash flows at a higher rate, which means your expectations are higher. So that's one angle that could explain the drop. And also the fact that drop may not be a long-term thing, but, for a period of time. The second is I actually do think that it is a positive thing from the perspective of making sure that fintechs take a step back and think about how to get to profitability, how to get to scale sooner. So I do think there is an element of growing up there that makes this a real serious contender when it looks at profitable businesses of the future. And finally, there is also for large organizations with the valuation declines that have happened, there are opportunities out there as well to partner with, invest, acquire, whatever it might be with some of these fintechs. So the bottom line is, I think it's potentially a short-term blip. I think there are silver linings in that, whether that is whether that be for the industry or whether that be for the larger organizations to partner with and invest in some of these fintechs as well.
Yeah, as ever. I mean, it does feel like there's real opportunities, Shehan, exactly as you say. David, I mean, I guess temporary blip or sort of more permanent shift. Keen to get your thoughts, but equally, I suppose it doesn't necessarily feel like we're going to return to those sort of halcyon days of endless VC funding and new unicorns announced sort of what felt like almost every day or every week, right?
No, absolutely not. And probably for the better, I would say. However, it still serves to boot that bringing a financial services product to market is extremely difficult and complicated, right? No matter how you split it. And getting a banking license is also very, very difficult. And in order for these businesses to remain successful, there's going to be a long time where they are unprofitable. And we do still need venture capital to be taking risk. And taking risk with underserved segments that are just more difficult to lend to and more difficult to serve. So at the one time, it's very easy to say, oh, we absolutely need to drive profitability, and we need to have that path. But on the other hand, it would be worrying if the risk appetite is withdrawn so much that we don't get the innovation that we desperately need.
No, completely agree. Val, final word to you.
Yeah, I mean, it just sort of makes me think of this this post I saw from one of the PayPal founders on LinkedIn earlier this week, and they sort of said, categories don't just pop out of thin air. You're always replacing something. We enjoyed music before Spotify. We found vacation rentals before Airbnb. We messaged coworkers before Slack. We hosted SaaS before AWS, and the list kind of went on. And I think there was so much of these solutions without a problem. There was so much silly money going around and silly valuations going around. I mean, the down rounds in some ways are sort of like moot points because, if you're listed, your share price goes up and down, and no one's like, sure, they mention, okay, share price is down by X percent, and it's up by X percent, but it's sort of like, it's just the way of the market. And that's going to happen in the private markets as well. But I think what it hopefully means is that you're going to end up with, not only, new categories being created, but also, businesses from existing categories, but doing things in a much better way and really genuinely innovating, as David says. Whereas I think before you almost could become a bit lazy because you knew there was so much easy money flying around. So hopefully we will actually see a huge amount of innovation and a different sort of generation of entrepreneurs kind of coming out of this. The best entrepreneurs thrive in times of turmoil, right? And we saw so much innovation come out of the financial crisis. So I'm sure we'll see the same coming out of this kind of cost of living crisis too.
I think that's it. And I think that's the ultimate, I suppose, note of optimism. But I think as well, we've touched on quite a few sort of lessons that can be learned over the last 15 years since the financial crisis as well that can be sort of carried forward. All right, I'm going to move us on to our next story, which comes from the Evening Standard with the headline, Snoop snapped up by Vanquis. So former Virgin Money boss Dame Jane Ann Gadia's money-saving app Snoop has been sold to a specialist bank 4 years after launching. Vanquis Banking Group said it had acquired the fintech platform for an undisclosed sum. The takeover is expected to help Snoop grow by bringing it under the ownership of the banking group, which is 1.7 million customers and which focuses on consumers who have been declined credit from high street lenders. The Snoop app aims to save customers up to £1,500 per year and helps business customers monitor consumer spending trends to better understand their customers. It uses open banking technology to connect to a customer's bank accounts and credit cards, and AI to sift through the retrieved data to find money-saving opportunities on bad deals, poor value renewals, and wasteful subscriptions. So Shehan, maybe I'll bring you in first on this one. What was your thoughts on the story and I suppose the benefits to both sides for the partnership?
Yeah, I think it's an interesting one. it's in the same sort of direction where the banks and some of these innovations or fintechs are partnering instead of the banks building some of this capability themselves. I do think it goes to the heart of data and using this data and insights, whether that is a transaction of buying and selling, whether that is a transaction of spending habits, and the ability then to embed finance within those customer journeys. I do think there's likely to be, more of a trend towards banks partnering with Invest in acquiring such, fintechs or entities that have the data and have the users and have the traffic that will provide that ability to then embed financial solutions.
Yeah, I really agree. Does this partnership sort of make sense to you, Val? Did it come as a bit of a surprise?
No, I mean, I think it makes sense. I think Vanquis is sort of known as one of those providers that's more for people who have difficulty in terms of, they might find it a bit more challenging to get, a credit card from or finance from another provider. They tend to have a bit more, potentially difficult credit track record or things on their credit history. So I think obviously in this environment, that's going to be even more important than it's been historically. Interest rates obviously where they are. We know that I think about 1 million people are going to see their mortgage increase. And a few million have already seen their mortgage increase, and that then obviously brings, affordability challenges. One of the businesses that we've now done a couple of lends to is a company called Money Plus, which helps people sort of manage their finances, overcome debt, and get on the savings ladder. And you often hear about getting on the property ladder, but the idea of getting on the savings ladder, just teaching people to put a little bit of money away, find where they might be able to make those small savings and then start to build from there. But taking that first step can often feel very overwhelming. And the fact is, with, unfortunately, the cost of living crisis, many more people need help from businesses like Money Plus and may in the future need to go to Vanquis or similar institutions because potentially they find it harder to go to some of those more, let's say, blue chip providers in the market. So I think, everyone sort of, it's good to know that there's institutions that are sort of filling the gap for those individuals. I think it makes total sense. Obviously, you see a lot of M&A happening in times like this. We haven't done anything this year, but last year we made an investment in ASK Partners, which is a sort of a debt, a sort of specialist debt provider. We acquired Fluidly back in December of 2021. We did put in a bid for Silicon Valley Bank. Obviously, we lost out to Shehan and his colleagues, but at HSBC. I think it's a market where you're going to see a lot of that happening, because there'll be a lot of businesses that that may find they don't have the runway, but also that they may find that they can achieve their ambitions much more quickly if they have an investment or get acquired by a larger company.
Yeah. And David, I suppose taking those 2 points together, Val mentioned that people are actively now seeking out ways to save money and actually to get better control over their finances, given the cost of living crisis and everything. How important do you think this is in terms of maybe giving Snoop a increased route to sort of scale through this partnership and the benefits for potential users?
I think it is really important because if you look at the open banking aggregation business model, wow, that's a mouthful. But if you just think about businesses that are set up to aggregate finances from multiple sources, give you the insight into your budgeting and then do something with that. There's definitely been a real struggle to monetize that, right? So Snoop sell a premium subscription, a lot of the others do as well. But ultimately that comes down to needing to sell a financial product in there somewhere in order to make profit. And so with Vanquis's credit cards, that in some ways makes sense. It'll be very interesting to see what they do with it. Do they keep it separate? Do they integrate it? Do they spin it off as a new revenue earner rather than just trying to sell their own credit cards? So it'll be interesting to see what they do. But I think, to Val's point about consolidation and M&A activity, a partnership like this does just make sense. I think in some cases it's a little surprising that it is a Vanquis. I think it's a very, very shrewd move and amazing timing. But yeah, it'll be interesting to see how many more of these deals are done in other countries where open banking aggregation exists that allows these business models to thrive.
Yeah. Shehan, one of the things I'm interested in here is I think Snoop is a great tool if you're already that way inclined, if you're already someone that is quite, plugged into their finances, that likes to understand where they're spending their money, that likes to actively seek out ways to make savings and all of that sort of stuff. I just wonder with Vanquis's sort of target demographic, which, are people, as Val mentioned, that might struggle to get credit from sort of high street banks, etc. Do you think, I guess, what are some of the challenges, or do you think they're going to be successful in actually really getting customers engaged with this type of product?
I think depending on I don't want to speak to Vanquis strategy in terms of their segment and such like, but if they do have the appetite and that is within their sweet spot in terms of the customers that they are going after, then certainly the data and insights and ultimately getting better visibility into the behavior of the customer will help, right? So and it's very similar to the work that we are looking to do with the JV and with Tradeshift. We want to work with a larger number of SMEs and smaller customers. And the only way you're going to do that with that aspiration and with that target is to find ways to mitigate the risk and to be able to give that credit. And that requires more visibility, more real-time data to understand what are they doing, where are they buying, where are they spending, how often are they getting paid, who is paying them, all of that. So I think, as long as that target market matches, then the data, visibility, and, all of that can only help.
Yeah, completely. And look, Val, final word to you. How do you think, they can do this? They can sort of manage and roll out this partnership to get the best from it, I guess, for those end users.
Yeah, I mean, I think looking at it from the other perspective, because we've sort of, talked about it from, they can, they'll be able to, with those customers who might find it more challenging to get credit from a traditional high street bank, potentially if they had access to this type of data and insight, they would be able to overcome some of the challenges that they have, right? A lot of the time it's, it's things that are, I don't know, maybe a bit more at the surface level, but it's, again, helping them to sort of reduce the debt slightly. It might be helping them to understand, how an interest rate is going to impact them. But I think sometimes someone just being able to see, this is how I'm spending, this is my outgoings versus my incoming, that kind of visibility can be very helpful. So I think using that to actually help improve the financial literacy of those people, as well as giving them, products that will help them to hopefully build up their credit score and get them the ability to, to get credit from other institutions, helping them build up some of that knowledge as well, I think is really key. So, I hope that that's what they'll also be thinking of as part of their strategy with this.
Yeah, I think that's really nice, because you mentioned earlier that managing your finances and getting on top of them can be completely overwhelming. So I actually think you're right. It's those initial sort of quick wins to help build their confidence, and then iteratively how you sort of move them along that journey. So I think that's exactly right. All right. Now for the section of the show called Big Click Energy, a quick fire roundup of some more click-worthy news this week. David, what have you got for us?
All right. First up, banks accused of closing accounts belonging to British Muslims from Sky News. British Muslims are having their bank accounts closed without adequate transparency and recourse, representatives have claimed. The Muslim Council of Britain said individuals and organisations in the community were being disproportionately affected by this issue, leaving the group with deep concerns. The body has written to senior politicians across political parties to call for a review into decision-making processes and the use of third parties in the banking sector. The Secretary General of the MCB said the arbitrary withdrawal of banking services by different UK banks has become par for the course over the past decade. To find out more about the current challenges facing British Muslims from a financial services perspective, we reached out to Haris Irfan, CEO of Cordoba Capital Markets.
There are two major challenges facing British Muslims using banking services in this country. The first is a lack of financial products and services that accord with their religious beliefs. And that challenge is a function of lack of representation in the Islamic finance sector. There's a huge cultural gap, a lack of affinity between the British Islamic banks and the people who seek their services. So it's no surprise that there's a lack of product. Now, the second is a much more topical challenge. It's the unexplained closure of bank accounts and denial of services to British Muslims. And it's taken the furore around Nigel Farage's bank account with Coutts to highlight what British Muslims have been dealing with for many, many years. And every time we've raised it, it's been completely ignored. Now, I've been approached on a number of occasions by Muslim charities and Islamic fintech firms complaining that they've had a denial of services or a closure of their bank account. And I advise them whatever I've been doing, which is I've learned to navigate this minefield by never making mention of the words Islamic finance or Sharia compliance or halal investment, which is pretty hard to do when you run an Islamic finance business. I also think it's pretty ironic that it took a right-wing populist to do us a favor and shed some light on what I believe to be a strong case of structural discrimination. I think banks need more diversity focus as part of their onboarding training. They need to look at their sanction list providers who need to get educated. There have been examples of a major mosque in this country that had its accounts shut down and it won an apology and damages because it had been wrongly linked on a global database to terrorism. These are the sort of stupid decisions that cause untold amount of suffering in the community. Many Muslim-run and law-abiding charities and other organizations have had similar problems, and we must have legislation or regulation to ensure that this cannot happen again.
It feels in some way, listening to that this is just the tip of an iceberg. And to recap for some of our non-UK listeners, the controversy over the last few weeks has been around this notion of a politically exposed person, which banks in the UK are able to make decisions to bank with a customer or close a bank account based on how exposed they are politically, both domestically and abroad. And it is not something that all countries around the world face. For example, in the US, they don't have such a policy. The real controversy has been around how the PEP law or regulation has been almost expanded or become expansive and pervasive across things that may or may not have anything to do with politics. And I really think what's going on here is, as Haris is alluding to, there is a wider, deeper problem with banking the unbanked and banking people who don't fit or conform to what a bank deems to be compliant. So I really think that we have a lot of work to do in this country around providing banking services and access to banking and credit into the future.
Yeah, and I think when you look beyond that sort of Nigel Farage circus, if some good comes out of it, then it looks to be that some genuine wrongs are actually being sort of called out and exposed. So we'll keep an eye on how this one plays out. It's now time for our And Finally section of the show, which, as ever, is a look at something a little bit more offbeat or lighthearted from the news this week. So this headline comes from the Daily Dot. Job applicant lists, quote, balloon animals on his resume. So boss brings balloons to the job interview. So many people add a few little white lies on their resume, but a dentist on TikTok shared that a job applicant listed, quote, balloon animals in the skills section of their resume, then was shocked when the interviewer wanted to see the balloon animals firsthand during their interview. So TikTok user Dr. Brady at Dr. Brady Smith, a dentist with over 263,000 TikTok followers, has garnered more than 412,000 views with his video sharing the story. So Brady lays out a scenario in which an applicant for the dental assistant position at his office listed balloon animals in the special skills section of their resume. He then added, quote, "Then I bring balloons to the interview and you can't make balloon animals. Not only are you not getting the job, but I'm pressing charges," he jokes. "To learn you're lying the whole time about that, like you belong in jail, you savage animal," he adds. That was a direct quote. I don't even really know where to start with this, as is often the case with our finally story. And I do think that producer Matt, whenever I'm on, just finds the weirdest ones that he possibly can just to sabotage me. Val, what is this?
I mean, look, I think, you have that sort of that bit at the end of your CV, which is sort of like other, or like hobbies and other interests. And if you have space, it's sort of where you put stuff like, I enjoy reading, I enjoy playing tennis, whatever. I sort of feel like if you've got the space in your CV for that, then great, have at it. I find I don't ever have the space. I'd rather use that space than to put some more information about me that's hopefully going to be relevant for the job. And, you can put other, special skills that might be things. If I was going to put one, I would probably say like mentoring, right? Because I am part of both formal programs for mentoring. I do a lot of informal mentoring. I'm hoping to get a qualification later this year in mentoring. And I feel like that's something that would actually be useful for any organization and hopefully could be a transferable skill if I'm managing people and so on. So I think, for the sake of a CV, you're trying to make yourself memorable or stand out, then you might get caught out, as was the case here. So, maybe this is probably more advice for some of your listeners who might be looking at, trying to get into the fintech world and looking at, making the move from university into or from, education into the workforce. And yeah, I just say, it's better not to lie on your CV. I mean, I can get by speaking French. I lived there in France for several years. I'm half Danish, so I speak Danish, but I don't put on my CV that I speak those languages because I don't feel that I'm very confident if I was to use those in a business context. I certainly couldn't do this podcast, for example, in Danish because I have no idea how to say things like venture capital in Danish, for example. So, I think as well, there's you have to kind of have some honesty, even, and if you're trying to sort of pad it out because you're earlier in your career, then it's better to just put things like you enjoy reading and you enjoy playing tennis, as opposed to something that you think will make you stand out in the pile of CVs someone might have on their desk.
Yeah, no, that's a fair point. David, I mean, keen to get your reaction. Totally take all of Val's points, but what if they missed out on a great dental assistant because of this whole balloon animals piece, which may or may not be relevant?
I know, it's such a shame, but also such a random thing to lie about. Like, why would you lie about that? How is that relevant to dentistry? I don't know. If you're going to lie, like, make it relevant to the job you're doing. It was a very interesting stat. According to a survey by Standout CV, 55% of Americans have lied on their resume at least once. So, like, this has got to be pervasive. But back to your point around what to put at the end, in some ways I can't escape it because I studied archaeology at university. So almost every single time I get asked, how the hell is your qualification in any way relevant to the job you're applying for? Like, what, or can you please explain that move? How did you move from digging a hole in a field somewhere to fintech?
I was going to say, so you could add in your special skills on your CV or resume, like good at digging.
Great, I'm so good at digging. Great with a shovel.
Shehan, what do you think? What was your reaction to this one?
Yeah, I think the stat really surprised me, to be honest. And my thoughts are, I think when you say line, I think, as David said, the relevance. And if you get caught out line, then the lack of trust and the downside is significant, right? So in my view, lies should not be there. Now, clearly on a CV, there's a lot of subjectivity, right? So, where you may want to express certain things, you may have certain views that certain things were very successful, and it might have been very successful is subjective, right? To one person, it might be one view, and to another person, another. And I think that's fine, but this kind of lie where potentially it's also not relevant to the job you're applying for, I think is a risky move and has more negative outcomes for candidates than positives.
Yeah, I totally agree. I bet in that person's head as well, they felt like it was a pretty safe lie, I guess, precisely because it was irrelevant. Like, there was never a world or a scenario that they foresaw where someone turned up with actual balloons and said, all right, then go for it. Let's see what you can do. But people are weird, and TikTok is weird. So that's my final word on it. All right, that wraps up this week's new show. Thank you so much to today's guests. Let's do a little once around the virtual room. Where can people find out a little bit more about you guys? David, let's start with you.
You can find me on LinkedIn at DavidBG.
Excellent. Shehan, how about you?
On LinkedIn as well, Shehan Silva.
Excellent. And Val?
Yeah, LinkedIn's good. And if you want to find out more about OakNorth, then oaknorth.com.
Excellent. And as for me, you can find me at RossGallagher07 on Twitter. And thank you for listening. Join the conversation on social media or email podcasts@11fs.com. Thanks very much and goodbye.